welcome to Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Chris Smith from the Option Club. Today is September 9th, 2015. Before we get started, a quick disclaimer, the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that disclaimer out of the way that this is for educational purposes, I will change the presenter to Chris. And Chris, welcome. I think this is the first time you've been a guest on the roundtable, but we've known each other for quite a while. I joined the Option Club years ago, and you did some work with Dan Sheridan when I was working with Dan, and that's where I got the idea to have you talk about this particular subject, because I saw one that you did in Chicago on the same thing and really liked it. So maybe take a minute to tell people about yourself and what you do, and we can get going.
Sure. Well, thanks, Tom. It's the first time I've joined you since you started Capital Discussion, so thanks for the invite. The Option Club dates back, it's been over 10 years now, but I started the Option Club, primarily to teach myself options and to learn how to use them effectively and well. I'd been trading stocks for a long time, and I wanted to incorporate options into it. And this presentation that we're going to do today, as Tom already said, I originally gave this back about 4 years ago at the CBOE, and along with Dan Sheridan. And so I've kind of trimmed it down a little bit, and hopefully we can get it in under an hour. The original presentation was about a half day, and so we'll cover as much ground as we can, and then we can take some questions at the end if people have them. But all this started because all the courses that I was looking at, back, probably around 2000, they all were teaching, short-term trading strategies, and what I was really interested in was figuring out how do I use options to manage my long-term investments and my long-term portfolio. And so this is kind of a very quick kind of review of kind of the journey I took to figure out how to use options and how to manage my long-term investments for both myself as well as my family. All right, so I've got similar disclaimers as what Tom has already read. We'll skip over those. The important thing on this particular disclaimer is that I'm going to share some backtest data and some hypothetical trade data. And the thing you have to understand is that while we try to maintain realistic conditions, the hypothetical stuff never really captures what you're going to see in the live market. It'll give you an idea of what it is, but there's going to be differences, and so you have to understand that before you start jumping in. So when I gave this presentation, this was not long after the 2008 financial crisis, and I saw this quote from Lloyd Blankfein, who these guys that are with these large Wall Street firms, they've taken a lot of money from both retail clients as well as retirement funds and that sort of thing, and they don't always have your best interest at heart. Is probably the kindest way that I can say it. And when some guy who just you just seen your portfolio cut in half says, "Gee, we have some reasons to regret the advice that we gave you, and we apologize," it doesn't really get you where you'd like to be. So the traditional investment advice, if you go to your corner broker or your financial manager type person, what they're going to tell you is they're going to want to put you in a diversified portfolio, and that's typically going to consist of some mix of stocks, some equity exposure, And typically that's going to be in the form of a mutual fund. If you have rather sizable accounts, you might have individual stocks, but more often than not, they're going to probably steer you toward some kind of equity mutual fund. And the same is true with bonds. Now, we're not going to talk about bonds today. That's an entirely different presentation. But typically, what you're going to be directed towards is some form of bond fund. And they might also talk to you about real estate, but for the majority of retail investors, if you own your home, that's a fairly significant amount of your capital that's going to be tied up in real estate right there, and so you're not going to. It's unlikely that you're going to put a significant amount into the real estate market. So you're really going to be focused on stocks and bonds, which is very traditional and which is kind of a universally accepted norm for investment purposes. You'll be told to rebalance the portfolio, meaning that from time to time you're going to want to reestablish the original percentage allocation between the stocks and the bonds. They're going to talk to you about dollar cost averaging, where you consistently add capital to the account, buying investments in good times and in bad, and average your cost in them. And most importantly, they're going to talk to you about buy and hold. Buy the investment and hold it for the long term. All right, so the foundation of this advice is what's called modern portfolio theory. All right, and this was first described by Harry Markowitz back in 1952. So even though we call it modern portfolio theory, I mean it's been around for decades. And the theory is that you can achieve kind of maximize your yields and your portfolio returns if you allocate the capital in a strategic way within various different asset classes. All right, now even though we're kind of relying on modern portfolio theory to drive a lot of the advice that's out there, you have to take it with some grain of salt. All right. Number one, this thing was developed. The core of that theory dates back to 1952. Options weren't even available on an exchange in 1952. You couldn't trade options. Even institutional investors could not trade options on an exchange. They didn't exist. You had to call some guy and you made these kind of off exchange deals, but we did not have exchange traded options back then. So a lot has changed. A lot of investments in financial securities that did not exist in the 50s are now available to us. So the primary concern that we have as long-term investors typically lies with the equity side of the portfolio, because that's where we're going to see most of our growth. Right? Very few, cocktail conversations center around your bond yields. It's usually, we're usually excited about the stock performance, the equity performance, because that's really kind of what gives us the biggest bang in our portfolio in terms of growth. And what we rely upon to protect ourselves on the equity side is diversification. Periodic rebalancing and the dollar cost averaging also factor into that. But what we're really looking at is we want to have a diversified portfolio. The problem that I saw with this, especially after the 2002 bear market, is that you're basically in an unhedged portfolio. Yeah, you have diversification, but it's not hedged. You're completely exposed to the directionality of the market. So this is what the risk graph looks like for the typical long-term equity portfolio. You've got unlimited opportunity to earn returns from market appreciation, but you also have that unlimited risk of loss to the downside. And we really like to have that unlimited profit potential. It seems like a very positive thing to us that we can make unlimited amounts of money, and but we have to carry, with that the thought that, I could lose it all too. And we usually really like the upside. We really hate the downside. And in a perfect world, we would eliminate, the latter and hold on to the former. So you have to ask yourself, well, what's my broker going to do about difficult markets? Right now, we're seeing a market correction. What's your broker going to do if you call them? And what they're going to tell you is that they're going to assure you that while the market's going to rise and it's going to fall, that you got to stay the course, and they're going to basically try to talk you into staying with them, keeping the investments that they have you in, and they're going to talk to you about the idea that we can't panic, just because the market goes down. You got to kind of stay the course and hold on for the long term. So the whole idea here is that we're going to buy and hold, and we're going to rely upon portfolio diversification to protect ourselves against catastrophic loss, right? And that's been kind of the centerpiece of the investment advice that we've been receiving for decades, for as long as I've been involved in the markets. So the problem is that in the first decade of this millennium, right? So from 2001 through 2010, that strategy failed, right? If you were a buy and hold investor in a diversified equity portfolio, that strategy did not work for you during those 10 years. All right, so what I have here is a chart of the SPDR, right? This is the ETF that tracks the S&P 500. That's a diversified portfolio, right? That's 500 stocks, and that's got as much diversification as a retail investor could hope to experience. And during that basically 10, 11 year period, the S&P 500 lost 8%. All right, so if you put all your capital into the market in 2000, on April 25, 2011, you were down 8.3%. Now, imagine if you were, let's say, 55 years old in the year 2000 and thinking that you're going to retire at age 65 in 10 years. Well, you've just lost a decade of growth, right? Not only did you lose the 8%, but you also lost the opportunity to make money during that period of time. So you also had to suffer through a 47% drawdown over a 2-year period from 2000 into 2002, right? So that's a real hard thing to stomach. And I remember my parents who were invested in the market, who were in fact retired. That was a very difficult 2 years for them. Now you made it all back, but then as soon as the market recovered that loss, then you had a 56% drawdown, and this one only took 16 months. So we really dropped like a stone and lost even more money than we did the last time. And as of 2011, we still had not recovered from that loss. And the thing that you really want to take away from today's presentation is the idea that this constitutes volatility. All right, so if you were in a long buy and hold position during that period of time, what you were experiencing, both in your account and probably in your gut, is volatility. So you go to someone who is recognized as one of the best long-term investors of all time, and one of the things I learned when I read about Warren Buffett was that he hated spending money. He was very reluctant to spend money, and the reason why was not only did he hate giving up that dollar that he was going to have to lay down to make the purchase, but what he saw was every other dollar that one would generate over the next several years, right? And what he was thinking about was the idea of compounded earnings. So compounding is the idea that if you have an asset that generates income or generates returns, and you reinvest that income or those returns, to generate even more earnings. That's what compounding is all about. So the problem we had in that 10 years wasn't that we lost 8%. The real problem was that volatility that we experienced during those 10 years robbed us of the opportunity to compound any earnings. So we lost, we had that, we were down 8%, but we also had given up 10 years where we weren't compounding any profits or any earnings. We were basically in a scenario where the only thing that was happening was that portfolio was being battered about, and it was devastating. So this was basically a lost decade for most investors because they were not able to compound, and the concept that you want to understand, the thing you want to hold on to here is that you want to earn profits, but as soon as you earn them, you want to be able to hold on to them so that you can compound those, take advantage of that power of compounded earnings. So you ask yourself, how much impact is volatility really going to have? And the reason this is important is because, especially in trading circles, a lot of times we're chasing what we call alpha, or the sheer increase or yield from our trades or our investments, and we don't think a lot about how much volatility that's going to create in our portfolio. So the graphic on the screen right now, this is a simulation. And you can run it. I think there's actually I think Tom put something like this in the Capital Discussions website. You can run this, and all of the variables are the same for both simulations, for both graphics, with the one exception of volatility. So in the graphic on the left, I put in 20% volatility, and on the right, it's a 40% volatility. So the max yields, everything else is the same. The starting capital is the same, and but you're getting a very different result over a 34-year period, right? So if you take a look at these graphics and you think about it, the message that really needs to kind of occur to you is, well, gee, maybe instead of focusing exclusively upon maximizing returns, maybe I need to think about reducing the volatility in the account. Because if I can reduce the volatility in the account, over the long haul, over the long run, I'm going to do a lot better. So how do we reduce volatility? Well, diversification is part of the mix, right? And what diversification does is it protects the account, it protects the portfolio against problems that might occur with discrete securities. So you have the situation where the company you own stock in has a bad earnings announcement, and the stock price drops. Well, diversification is going to help mute that financial knock, right? Because the other stocks in your portfolio presumably haven't had the same bad luck and are still holding up, right? Or the CEO is found doing something that's that CEO shouldn't do, and it impacts the stock, right? So that's what diversification is going to protect you against, are those discrete issues that pertain to a specific company. But what it doesn't work for is the wholesale market-wide sell-off. When the market as a whole heads lower, diversification is not going to work for you. So here's a picture or a graph of the Fidelity Magellan Fund from 2000 to 2011. This is a diversified fund. It's an actively managed diversified equity fund, right? And over that 10, 11 year period, it lost 42%, almost 43%, right? Diversification didn't do anything to protect you from that. This is the NASDAQ 100, right? This is 100 stocks on the NASDAQ. Over that same period of time, you lost 32%. You lost a third of your account's value. Diversification didn't protect you. Here's the Janus 20 fund. This is probably more similar to most individual investors' accounts who invest in individual stocks. Why? Why? Because most of us can't afford to invest in 500 stocks. A lot of us can't even afford to invest in 30 stocks, right? It's just too many. But 20, now we're starting to get into a number where maybe maybe that's realistic in terms of a retail stock investor's portfolio. Janus 20 did better than most of the others, but you still lost 14% over that decade. So how do we reduce volatility besides diversifying? All right, and so what I got into was the idea of a hedge portfolio. All right, so this is not about using options necessarily to increase returns. The goal is to decrease volatility. All right, remember back to the graphic where we had the 20% volatility portfolio and the 40% volatility portfolio, right? And the 40%, it was up some years, down other years, and the net result is that you're not making a lot of money over those 34 years. But if you reduce the volatility, then you can start holding on to and compounding the gains. So the next kind of chapter in this study is the use of covered rights, right? Because a covered right, even though you have that unlimited downside risk, is in fact a hedged position. So I started evaluating the covered right, and for our purposes in this discussion, we're going to define a covered right simply as being long the underlying equity and selling option premium against it. Simple enough, right? So when you do that, you're going to limit your maximum upside potential, right? So you have a limited amount of money you can make to the upside, but you're going to have unlimited risk to the downside. And so here's the risk graph for your basic covered right, right? There's 100 shares of the spider and 1 short call option. All right, and you look at this and you think, well, gee, how can that be a good idea? I have all the risk in the world, but I only get to make a little bit of money. How can that work for me? All right, so we have a limited potential profit. We have unlimited downside risk. So then you ask yourself, well, gee, am I just better off being long the stock? Because even though if I'm long the stock, I've got all that downside risk, I also have an equal, actually greater potential gain, right? Because my risk is limited to the capital I've spent, but a stock, in theory, could go up forever to infinity. Covered call, on the other hand, can't go to infinity, right? It's limited. So how or why would I want to do this? The next thing I did is I started looking for some facts, and that was not going to be found in internet discussion room or anything like that. So I started looking towards some recognized authorities, and the CBOE was one of the most reputable ones I could find. Now the image I have of this website, this is probably like 4 years old, so the website's probably changed. But I think they still have the same information available. You might just have to hunt around for it a little bit. So what I did is I went to the index site and I clicked on the CBOE Buy Right Index. And what the CBOE Buy Right Index is it's a hypothetical index, very similar to like the S&P 500. In fact, what it is it simulates buying the S&P 500 and selling front month calls against it at the money. And so now we've got an index, right, which is the Buy Right Index, and we can compare that to the S&P 500. So what I did is I got a graphic from the CBOE site, And we have annualized returns and we have standard deviation. Standard deviation is essentially a reflection of the volatility in the value of the hypothetical account, right? So as far as the annualized returns go, the longer the bar, the better. For standard deviation, the shorter the bar, the better. All right. And as I kind of dug through this, some interesting things occurred to me. First of all, here's the S&P 500. Over the period of time from January 31, 1991 through January 31, 2011, the S&P had a 9% annualized return. So on average, good times and bad, on average, you're making about 9%. The BXM, which is the buy right index, right? So now what we're doing is we're buying the index, the S&P 500, and we're selling calls against it. And even though we have that limited profit potential, the average return on the BXM was 9%. All right, so the S&P returned 9% and the BXM returned 9%. So then some question should occur to you, and that is, why would I want to go through all the trouble of having to buy 500 stocks and sell call options against it when I could just buy the stocks and forget about it? I don't have to do anything. I just buy the stocks and get the same yield on average as the buy right index. And that's when the standard deviation comes in, becomes key, because the S&P 500 had a 15% standard deviation versus the BXMs of 10.7. So by selling those calls, we did not degrade the yield performance at all, but we cut volatility by a third. So same yield, less volatility. So then here's a couple others. BXY, this is the same thing as the BXM, except instead of selling at the money call options, we're going to sell them 2% out of the money. So what that does is it still brings in premium, not as much, but it gives us more room for upside profits. And that beat the S&P 500 on a yield basis. And it also beat it in terms of volatility. It had less volatility but better yields. The surprise to me, this was the biggest surprise, was that the put right index had a 10.3% yield, which beat everything else. So it was the highest yielding. It was also the least volatile. Selling naked puts on the S&P 500 had less volatility than owning the S&P 500. Go figure, right? And these aren't my numbers. These all came from the CBOE, right? So, when I started seeing these numbers, I started thinking, it makes sense to sell premium. Here's a performance comparison. All right, the pink line at the top, that's the put index, and then you got the BXY, the BXM, and then the S&P 500. All right, and so the idea here is that this chart is assuming that if you had invested the same amount of money in these hypothetical indexes, that over the course of from 1988 to February 2010, those are the relative yields. All right, and the top three are all short premium strategies. All right, and that's kind of important to keep in mind. The top three short premium strategies. So after discovering this and thinking about it, I started engaging in some of my own analysis. And what I kind of focused on was the idea that compounding refers to the ability of an asset to generate earnings, which are then reinvested to generate additional earnings. By selling premium month after month, year over year, taking those premium dollars, reinvesting that income, we're taking advantage of compounding. All right? So when we look at the risk graph of a covered call and we see that limited profit potential, we're not seeing the whole picture, because that picture is only for 1 month. And we're not in the trade for 1 month. We're in the trade for 30 years or 20 years, or whatever your time horizon is. But the point is this is long term. Right? We're not, we could have a short-term trading account, but what we're talking about right now is our long-term investment account. So when we look at a risk graph of a covered call, that's not an accurate reflection of what that strategy is intended to do for us. All right. At the money and out of the money options are comprised of extrinsic value, right? We call this time value, or some people call it time value, but it's extrinsic value. All right. So how, what creates extrinsic value? If you have some familiarity with the Black-Scholes pricing model, you know that the variable that drives extrinsic value is implied volatility, right? If you increase implied volatility, extrinsic value increases, right? Option premiums become more expensive. If you decrease implied volatility, they become cheaper, right? So in effect, by selling options, we're selling the extrinsic value, right? So we're selling at the money or out of the money options. By doing that, we're selling the extrinsic value in the option, which is tantamount to selling implied volatility. In other words, we're moving volatility out, right? And if if you're questioning whether that's really true, think of the vega for a short premium trade, like a covered call or a short put, right? The vega is negative. So we're adding negative vega to the account. We're reducing the volatility. So the conclusion I came to was that by strategically selling option premium, it allowed me to reduce portfolio volatility. And by reducing volatility, it should allow me to improve my risk-adjusted returns. The key beyond selling the premium was that you got to take the premium and you got to reinvest it. All right. So if you're a covered call investor where I know some guys are retired where they like to sell the options for income that they then use to fund their retirement, and that's fine. It's just you're not compounding it, right? Because you're spending it. You're going to take that money and pay the bills with it. So now I need to apply this information. You guys can all stop right here, right, and take this information, and tomorrow morning you can implement a covered call on the S&P 500 strategy, right? The problem is there's no way for us to buy the S&P 500. And the reason is because the S&P 500 is a hypothetical index. There are no shares of the S&P 500. So what you need to do is find a surrogate. And there's a lot of them out there. There's mutual funds, there's ETFs. You could also go out and buy the 500 stocks in the appropriate ratio. The SPX is not going to be a viable surrogate because there is no underlying on the SPX. Right? You can't buy the SPX. You can buy options on the SPX. You can sell options on the SPX, but it settles in cash, so you can't own it. You can't own the SPX. The best surrogate you're going to find is the SPDR. And the reason is because it's an optionable, highly liquid ETF, right? Mutual funds, you can't sell options against your mutual fund. So really the only one that fits the bill out there is the SPDR. It's the best choice, and because it tracks the S&P 500 very well, it has a highly liquid option chain. So if you want to implement an at-the-money covered call strategy, or a 2% out of the money covered call strategy, or a short put strategy, that's where you want to go, is the SPDR. Does it work? And so what I did is I back tested it. Okay. Now, I'm going to remind you, we talked about at the beginning of the presentation, the disclaimer that back testing is not the same as trading. All right. So these are simulations. Now, back testing is a really great tool for developing ideas, for testing your ideas, and for getting a sense as to whether or not something has some efficacy about it. So the test period from January 18, 2005 through December 31, 2013. Why those dates? Well, based on what I understood at the time, was January 18, 2005 was when you could, before that, the options were not available on the Spider. So I started the strategy on January 18, 2005, when I first was able to get the option pricing data in my software, and I was testing it. When I did the back testing, it was January of 14. So the last expiration was the December 13 expiration. So basically, this represented at the time the entire lifespan of options on the Spider. $100,000 hypothetical Reg T account, right? So I assumed I had $100,000 in cash and had full margin, right? So in other words, I was not borrowing any money. I was paying full price for the shares of the Spider. The control is buy and hold strategy. All right, so I'm comparing the results of the buy right strategy against just the straight up buy and hold strategy. So the control was on January 18, 2005, bought 847 shares at $118.05 for a total price of $99,988.35, and I had $11.65 in change left over. Then on December 31, 2013, at market close, I sold all 847 shares, right, for $156,432, and I still had the $11.65 in cash, right? So I made a decent little profit, right? Per share gain of $66.64, which was a 56.5% yield, which is approximately 4.3% annualized. That's the control. All right, covered right back test rules. So if you wanted to do this, you could use these same rules. I started on January 18, 2005, no market analysis, all was invested, 100% capital allocation. Basically, I purchased as many shares of the Spider as the available cash in the account will allow, even if it results in an odd lot. In other words, if I had, if I could buy 105 shares, I bought 105 shares, not just 100 shares, right? So then I would then sell one at-the-money call option for every 100 share block of the Spider. I would ignore all market activity and hold the position until the expiration of that option. And I wasn't selling, the weekly options. I was just doing the regular monthly options. So then here were the rules. If the short call was out of the money, I allowed it to expire, or I bought it back for a nickel. And then I sold another at-the-money option in the next month for every 100 share block of the Spider. What I didn't say here, and the reason I didn't say it is because it never occurred, was if I had enough cash to buy another 100 block share from the premium sales, then I would add additional shares. But I don't know that I ever had a month where I generated enough cash to do that. So then if the short call is in the money, I just accepted assignment, right? I didn't try rolling it or anything like that. So I'd accept assignment, and then the following Monday I'd go repurchase as many shares of the Spider as I could and sell another at-the-money call. If the call was, short call was at the money, I'd roll the option to the next month's at-the-money strike. So I'd just roll it horizontally out 1 month. And then on December 31, 2013, I basically marked to market. I closed the position at the closing price of the options and the ETF. All right, so here's the performance history. All right, so this is the software tracking it from the beginning, January 18, 2005 through the end. All right, so we made just under 59% yield. Here is the performance analysis. So the return was 60.2%. So the graph, I guess, was a little bit off. The annualized return was 6.7%. All right, so that's a 60% yield on the at-the-money covered call strategy versus a 56.5% yield for the buy and hold. And then the annualized return was 6.7% versus 4.3% for buy and hold. Okay, so we had better performance during that time period, and we probably had less volatility. Right? I didn't measure volatility, but my strong suspicion is that we have a lower vol number. So then the question becomes, well, how can we enhance the yields further? Question was, does that include commissions? The answer is yes. Commissions were included. And I think I usually use $1.50 per contract as my options commission. So enhancing yields further, like I said, you guys could leave the presentation right now, and you could go ahead and start selling calls on the spider. Completely viable strategy, and you'll probably outperform the market in most years. Okay, or we could start building on these same principles, and we can add some stuff, right? Because I ignored market conditions. We could start adding market analysis. I was buying my shares with cash, so we could start maybe taking advantage of some leverage. Maybe we could add some additional hedges, right? Maybe we could start actively managing the portfolio, because that strategy is not an actively managed strategy, right? You're just mechanically buying the index and selling the calls. So maybe we could start actively managing the portfolio. So that brought me to the idea of running the account much like a hedge fund, as opposed to a trading account or a more traditional long equity investment account. And so what I've got is I put a lot of this into a white paper, and if you guys want to take a look at the white paper, it's free. You just go to the website. I think you put your email in, and you're able to download it at no cost. And there's some videos and that kind of detail in a lot more. Goes a lot deeper into the back testing and the analysis than what I can do in the amount of time that we have today. So I told Tom I would do this under an hour and leave some time for questions. So if we have questions, I'm ready to go with those.
Okay. Andy asked, did you consider the effects of dividends?
No, I ignored dividends, and the reason why is because unless you get called out early, the dividends were going to be the same whether you were holding it long or not. But I did not include dividends, and that might change the result a little bit.
And he also asked, in your SPY test from 2005 to 2013, can you please show the difference in the volatility of SPY versus the covered rights?
Like I said earlier, I didn't calculate the vol for the covered right. We could probably do it fairly easily for the SPY on its own. But what we could do, let's go back here one. you can basically see, the big drawdown occurred in May 2008, right? That was the financial crisis. That was the big meltdown, and so we know that was a 50-something% loss on the S&P 500, right? And so we probably went down. I'm going to say that's what, maybe somewhere between 126 and 135. So let's call it somewhere in the middle, and let's just call it 130,000. And we went down to what? We'll call that 90,000. So we lost 40,000 on a $130,000 account, and so 40,000 divided by 130,000 would be what, a 30% decrease versus a 50+% decrease. So you're going to have less volatility in the covered right.
Yeah, I think you could add some simple filters too to not be in the market on those big down periods too.
And that's what I did. That's what we talked about. When we were at the CBOE doing the presentation, we added market analysis, and the market analysis. If we were trading, if you were running a trading system, you would have a mechanical system that would put you in and out of the market. And I haven't gone there for the long-term strategy, and there's reasons for that. But what I have done is I've developed basically a series of analytical tools that I like to use that move me out of the market when things start looking like they're not going to go well. If you're a student of the market, what you know is that over time, the market will spend 70% or better of the time moving higher, and then it will be marked by periods of downturns, bear markets and such, things of that nature. And so the trick is to be in the market 70% of the time and try to get out of the market when things head lower, which we could call market timing. And the reality is you're never going to get in the market at the bottom, and you're never going to get out of the market at the top, right? So what we did is we worked on a strategy where we would get in the market at opportune times, and then we would exit the market when the risk of a loss outweighed the potential for profits. And over the long term, it tends to do pretty well.
A couple more questions. Avi asked, did you ever consider buying leaps and writing a covered call as in stock replacement strategy?
Yeah, and that was what we talked about in the afternoon at the CBOE was we went through different iterations. We looked at the covered right strategy, which was the first one, and then we moved into kind of rotating from short puts into covered calls in what we call an option wheel strategy, and then we looked at leveraging the whole thing by using leap options. And the idea is that you're going to buy a deep in the money leap with a high delta, and that leap option will kind of mimic what stock does because it has a high delta. In other words, if you buy an 80 or 90 delta leap, you're going to be capturing 80 to 90% of the price move in the underlying. So, it behaves in a very similar way to the stock. And we could talk more about it, but if you buy into that concept, then the next thing you realize is that the amount of money it costs to buy an 80 or 90 delta leap option is a lot less than buying 100 shares of the underlying. So what we can do is we can buy more leaps then you can buy with 100 shares of stock. So these 100 block shares cost more than a single leap. So what we're able to do is get more delta that using the leaps than buying the stock, because the stock 100 shares of stock, the delta is 100, right? And if I can buy 2 leaps for the same price of the stock, I could be picking up 160 to 180 deltas for the price of 100 deltas. And it's actually, the pricing is actually better than a 2 to 1. You're buying a lot of delta for less money, and the yields reflect it. In other words, when that trade works, your yields are going to far outperform the standard covered call type strategy. I mean, it comes with a price. You have a lot more risk, but you have to learn to manage it and control it. But your yield potential, I mean, realistic yield potential is, instead of chasing after like 8 or 9% a year, you can be chasing after more like 20 to 30% a year.
Andy asked another question. If the volatility reduced that much, why did returns not increase significantly in your 2005 to 2013 SPY backtest as compared to the simulation chart you showed, 20% versus 40%?
Good question. I don't really have a great answer for that. I took the CBOE information at face value. I don't remember exactly what I read, when I was looking at it, several years ago, but the results were audited, and I don't remember the firm that did the audit, but they were audited results, and so I had confidence that the information being displayed was accurate. And in the back test, I mean, I used the same tools that a lot of you guys have. As option view was what I had at the time, and I followed the rule set as accurately as I could and try to simulate it as best as I could. Now why would the yield performance not be a whole lot better? Well, as compared to the graph of the volatility, the 20% vol versus the 40% vol, you have to remember that graph was over a 34-year period. All right, and this one is over what, like a 8-year period, right? Maybe not even 8 years. So it's a much shorter period of time. So what does compounding need to really show you its power? It needs time. Right, so the more time you give it, the better yield performance you're going to get. But I was limited in my back test to those 8 years because I could not get options on the SPY before January 18, 2005. So those are my thoughts, but I mean, I don't have a calculation, or I haven't worked anything out to explain it in a more scientific way.
Yeah, and that presentation, though, that got me thinking about reducing the variability of the returns that you have. So reducing the big losses really makes a much bigger impact in your returns than you think.
Well, and it does, and I started seeing it because when I started learning about options, what everyone was teaching at the time were short-term strategies. Like the longest term strategy someone was teaching at the time was like a 3-month calendar spread, or I mean, it was all very short-term trading focused, right? I could not find anyone who was teaching anything about how to manage a long-term investment account with options. And so when I started learning options, I did a lot of short-term trading, and some months were really good, and some months weren't so good, and I learned a lot of hard lessons the hard way, where it cost me $10,000, $20,000. I mean, I still remember the one that cost me 20 grand. And the short version of that story is never hold short options on the RUT or the SPX, into expiration. Never do it, because surprises do occur, and and it happened to me. But the the upshot of it was, even though I was having some spectacular wins, the volatility in the account was making it very difficult for me to get good traction and grow the account. And as soon as I pulled back on that stuff, reduced the volatility, and kind of refined my methods, the yield performance started picking up. And what I assumed was that I would outperform the market when the market was flat and when it was down, but that the market would beat me if it was in a sustained bull run. Because I assumed that by selling the covered call type strategy, having those short calls, that it would reduce my performance to the upside. And using the combination of strategies, between selling puts and covered calls, and using those deep in the money call diagonals, I typically outperform the market by several percentage points now, even during the bull run. When we, in the last couple of years where the market was on kind of this unrelenting upward trajectory, I was still able to do fairly well.
Let's see, I think one more question, and we're running out of time, so I think we'll end up pretty close to an hour. But Andy asked for back testing. He's used Black-Scholes with VIX to do a similar type of test. It wasn't perfect, but very fast. He wondered if you have any other ideas.
I don't. I gave up my subscription to OptionView last year, primarily because I'm kind of like settled in my approach, and so I'm not doing a lot of back testing anymore. So I've kind of gotten away from it. So I don't really have any great insight. Most of the back testing I've done is using historical option prices in a tool such as OptionView or OptionNet, or there's a few others out there. And what I used to do before that was I would get historical option quotes and kind of estimate where I could get filled and things like that. And my experience is that back testing options it's hard. It's hard to get accurate results. The best you can do is get a sense of it and get a sense of what works and what doesn't work, and then try to refine it in small positions in the live market.
And then I guess one more question. They asked if I could post a link to simulate the returns with different volatility levels. I think he's talking about the trade simulator, right?
Yeah. Did you? I thought you had a. I remember seeing a tool that I thought maybe you could put in there.
Yeah, I do have a tool. Let me see. Trade simulator. Here it is. I'll just paste this in the chat for everyone. It's on the Capital Discussions website, and just under the Tools menu. But you can basically pull that tool up and then change the range of your winning trades and your losing trades and the win percents and play around with it. And if you set the number of trials, then it's just like, think of it like the number of traders that you have going. So one trial is one trade. It gives you all the performance summary. But if you have multiple trials of, say, 150 trades, and you do, say, 100 trials, it's like 100 different traders doing 150 different trades, and it'll show you an envelope of the best and the worst and the average of all those. And it's really interesting to play around with that.
I think there's a URL under the graphic. I don't know if anyone can see that because it's kind of small, but I got my simulator. I think it was a download, like a Excel spreadsheet, and I probably spent like an afternoon just playing with it and changing the variables and rerunning the simulations. These simulations are not static, so every time you run it, you're going to get a different graph. So, if you run it 100 times, you're going to get 100 different graphs. But if you run it enough, you start getting a sense for, what's likely to occur given different volatility profiles. And candidly, when I pick these graphs, I kind of pick the the more extreme in terms of the results. Just to make the point. So you're not always going to have the bottle rocket and the thing crawling along the ground here, but the principle is going to you're going to see that play out though. You're going to see that general concept play out that your yields will be consistently better over long periods of time when you reduce volatility. And that's the key, because this is 34 years, right? And how can you get a 34-year perspective as a trader? It's really hard to do it, because most of us haven't been trading for 34 years. So what we see are month-to-month gains, year-to-year gains. And so a lot of us end up over on this side, on the right-hand side with a 40% vol portfolio instead of the 20% vol portfolio, because we don't see the long-term impact of that volatility. What we see is the immediate returns on discrete trades or positions. Right? So what we see is I made 1,000% on that long call option. I'm going to trade more long call options. Right? And that's what a lot of people kind of fall victim to in when they start buying into these various trading courses and things. They say, look, we're going to chase after these really big yields. And that's fine, and I've done it, and every now and then I still do it. But you have to kind of keep the big picture in mind, is that you don't want to own a portfolio of long call options, because it's probably going to be a very volatile portfolio. So what you do is you create a, if you want to chase those types of yields, you create a discrete portion of your portfolio that is limited in size, and you rely upon the diversification throughout the rest of the portfolio to kind of offset the volatility you're going to create in that little bit. So if you have, like, say, $1 million portfolio and you want to allocate $100,000 to trading, great. But if you have a $100,000 portfolio and you want to trade it all, you got to be prepared to deal with this, the volatility issue. And most people I've talked to on the retail side, just it hasn't even occurred to them. They don't have any understanding of what it does over the long term.
Right. Well, Chris, as Andy said, excellent presentation, well organized and clear message. Thanks for doing it. Really appreciate it.
Glad to do it, you guys. Tom, thanks for the invite.
Yeah, and maybe we can have you back in the future. It'd be great. Nice to reconnect, Chris. Appreciate you coming on.
Sure thing, anytime.
All right, thanks everyone. We'll see you next time.